Welcome to The Explainer, everyone. Today, we're diving into a roadmap that's going to show you how to turn a simple saving habit, like putting away, say, 5,000 rupees a month, into actual long-term wealth. Now, I know for a lot of us, the stock market just feels like this giant, intimidating mystery, right? But what if we could totally eliminate that fear? That's exactly what we're doing today. We're breaking down 8 years of hard-earned, real-world retail investing experience into a super simple, step-by-step guide made specifically for the Pakistani market. Let's get right into it. Here's the 5-step roadmap we're going to follow to build up your financial literacy and confidence. 1. The silent threat of inflation. 2. What exactly you should invest in. 3. Figuring out if you're actually ready to invest. 4. How to open an account and start buying. And 5. The golden rules for long-term wealth. All right, part 1. The silent threat of inflation and how rising prices literally steal your savings. So we have to start with the core problem here. You work really hard for your money, but if you just leave it sitting around in a bank account or under a mattress, you are actively watching it lose its purchasing power. Inflation is the rate at which your money's power decreases day by day. It makes everything more expensive over time. Think about your daily groceries, right? If an egg costs 35 rupees today and by next year it costs 40 rupees, that 5 rupee difference, that is your hard-earned savings slowly evaporating. It's not just that things are getting pricier, it's that your cash is getting weaker. If you don't step up and protect it, maintaining your current lifestyle in the future is going to be a massive struggle. To put that into perspective, let's look at a really concrete example. Imagine you have 1 lakh rupees today. Now, with Pakistan's average inflation sitting right around 10%, what actually happens to that cash in just 12 months? Visually, physically, yeah, it's still a 1 lakh rupee note, but in terms of its actual purchasing power, it is effectively dropped to 90,000 rupees. Your money is quite literally shrinking in your pocket. And this comparison right here brilliantly shows the devastating outcome of leaving your money uninvested. If you just toss that 1 lakh rupees in a drawer for 20 years, inflation is going to eat it down to a real value of just 14,343 rupees. You've basically lost everything. But if you invest it, say at an average 17% return, and this is even after factoring in that 10% inflation rate, the real purchasing power of your money skyrockets. It triples to 3,43,000 rupees. So you aren't just protecting your money, you're literally multiplying what it can buy. So how exactly does the stock market build that kind of wealth? Well, when you buy shares, you aren't just trading random numbers on a screen. You are becoming a minority shareholder in real, physical, everyday businesses. Take National Foods, for example. If you buy their stock, you own a tiny, tiny slice, maybe 0.0001% of that actual company. Meaning, when people go out and buy more of their ketchup and the business grows, the company's overall value increases, and your shares go up. You profit right alongside them. Moving on to part 2. What should you invest in? Let's look at the 3 main paths for your money. Okay, so now we know why we need to invest, but where do we actually put the money? There are 3 primary avenues for jumping into the stock market, and they're great because they cater to totally different levels of expertise. You've got mutual funds, ETFs, which stands for exchange-traded funds, and individual stocks. When we compare these options, a really clear distinction pops up between mutual funds and ETFs. With mutual funds, you don't even need a broker. You just open an account with an asset management company, and professionals actively manage a pool of money for you, usually for about a 2 to 3% yearly fee. ETFs are kind of similar. They also hold a basket of stocks, but you do need a brokerage account to buy them. The upside? They generally have much lower management fees. And then, of course, there are individual stocks. Now, if you're a new investor going down this route, index investing is highly, highly recommended. By focusing on the top companies within the KMI 30 or KSC 100 index, you're making a much safer bet. Your portfolio naturally grows with the top 10 to 20 performing companies in the country. It takes a ton of pressure off you so you can passively invest while you take your time to really learn the ropes. All right, part 3. Are you ready to invest? There are 2 mandatory conditions you need to meet before starting. Hold on a second, though. Despite all those incredible benefits we just talked about, investing isn't for everyone right out of the gate. Before you buy a single stock, there's a mandatory checklist you have to clear. Step 1, you absolutely must eliminate all high-interest debt. If you're pulling at a 15% return in the market but paying a massive 30% APR on a credit card, you are actively losing money. Makes sense, right? Step 2, you've got to build a 3 to 6 month emergency fund. The market fluctuates, that's just what it does. If an emergency hits and you don't have cash ready to go, you'll be forced to sell your investments early. You might take a loss, and you'll probably get hit with capital gains tax. So secure that foundation first. Once that foundation is set, how much should you actually invest? Well, the golden rule here is to only invest money you are certain you won't need for the next 3 years. A really solid starting point is a 40-60 split. You put about 40% of your savings into the market. That remaining 60%, keep it safe and diversified. We're talking gold, your emergency savings, or Sharia-compliant money market funds. This balance keeps you totally protected while giving your wealth room to grow. Which brings us to part 4, opening an account and buying. Let's walk through your very first steps in the digital market. Let's tackle the logistics and completely remove that fear of the unknown. Setting up an account today is incredibly simple. You actually have 2 options. An easy account requires literally nothing but your CNIC, and that lets you invest up to a 10-lock limit. But if you want to go for a normal account with no limits, it only requires 4 basic things: your CNIC, a salary slip or some proof of income, your signature, and a picture of your checkbook. That is it. It's honestly just like opening a standard bank account. And the actual process of buying a stock? Astonishingly easy. You don't need to be shouting on some chaotic trading floor. Step 1, just open your broker's app on your phone. Step 2, select a company, let's say Effort. Step 3, enter the quantity of shares you want, maybe 10. And step 4, press done. Boom! You just became a shareholder. Starting small like this, even if it's just with a few thousand rupees, is hands down the best way to permanently crush any fear you have of the stock market. Finally, part 5, the rules for long-term wealth, covering mindset, myths, and market cycles. As we wrap up, we really need to talk about the mindset required to survive and thrive as a retail investor. The mechanics of buying are easy, but the psychology, that's where wealth is actually made or lost. We have to address some cultural hesitations head on. A lot of our elders called the stock market a gambling den, and a lot of younger folks think it's some get-rich-quick crypto-style scheme. Let me be clear, it is neither. The stock market is a slow, long-term wealth-building tool. It requires immense patience and a whole lot of delayed gratification. There's also this massive myth floating around that all investing is interest-based or non-permissible. But in reality, Sharia-compliant investing is entirely possible. There are dedicated Sharia boards that strictly regulate and filter these companies. You have 100% complete control to choose only Sharia-compliant businesses. So consider that myth totally busted. Participating in the market absolutely does not force you into interest-based activities. To really succeed, you've also got to understand that markets move in natural cycles. We call them boom and bust cycles. A bull run, where everything is just going up and everyone is making money, feels fantastic, right? But it doesn't last forever. Bear runs or economic slowdowns are completely inevitable. A massive indicator you want to watch here is interest rates. Generally speaking, when interest rates start rising, a stock market's bull run is going to begin to slow down. You have to mentally prepare yourself for these cycles so you don't panic and sell everything at the worst possible time. I want to leave you with a really powerful concept: personal agency. It's simply the ability to figure things out. If you heard terms today like balance sheets or bull runs that you didn't fully understand, leverage your curiosity. Look them up, ask questions. Fear only exists where there's a lack of understanding. The second you take the initiative to learn, the light of knowledge just completely eliminates that fear. Remember, the silent thief of inflation is not waiting around for you to feel ready. So the question is, are you going to let fear dictate your financial future? Or are you going to take control and make your money work for you starting today?